Q.1 Is there a need to regulate financial services in India? What are the different types of regulations relevant to these services? Describe the regulatory framework governing this sector in India. Answer. Is there a need to regulate financial services in India? Financial services form the backbone of any modern economy. They include banking, capital markets, insurance, pensions, payment systems, and a wide range of intermediaries and instruments that mobilize savings, allocate credit, manage risks, and enable smooth functioning of the economy. In India, where financial inclusion, economic stability, and investor protection are national priorities, the regulation of financial services is not merely desirable but indispensable. Why regulation is necessary? 1. Financial stability. Unregulated financial markets can lead to crisis, as seen in the global financial meltdown of 2008. In India, with a highly interconnected financial system, the failure of a bank, non-banking financial company, NBFC, or mutual fund could spread quickly to other parts of the economy. Regulation ensures that capital adequacy norms, liquidity management, and risk frameworks are followed to prevent systemic instability. 2. Consumer and investor protection. Retail investors often lack the knowledge to assess risks associated with financial products. Regulation ensures transparency, fair practices, and disclosure norms, thereby protecting consumers from fraud, mis-selling, and exploitation. 3. Prevention of market abuse, insider trading, price manipulation, money laundering, and fraudulent practices are common threats in financial markets. Regulators enforce strict surveillance, monitoring, and penalties to deter such behavior. 4. Promoting financial inclusion. Through regulation, policymakers can ensure that financial services reach marginalized sections of society. For example, the Reserve Bank of India (RBI) licenses small finance banks and payment banks to widen access. 5. Encouraging innovation with prudence. Regulation balances innovation, such as digital payments, fintech, and credit on UPI, with systemic safety. Regulatory sandboxes allow experimentation while managing risks. Thus, regulation plays a dual role, promoting development and safeguarding the system. Types of regulations relevant to financial services. Regulation in India can be broadly classified into the following categories. 1. Prudential regulation. These rules ensure the soundness of financial institutions by requiring adequate capital, liquidity, risk management, and governance. Examples: RBI's Basel III norms for banks, IRDA's solvency norms for insurance companies. 2. Conduct and market regulation. These protect investors and ensure fair market practices. SEBI's insider trading rules, prohibition of fraudulent practices, and disclosure norms for listed companies fall under this. 3. Business conduct and consumer protection. This type of regulation mandates fair treatment of consumers. Examples include SEBI's guidelines on mutual fund disclosures and RBI's fair practice codes for lending institutions. 4. System oversight and payment regulation. Given the criticality of payments, the RBI regulates payment and settlement systems like NEFT, RTGS, IMPS, and UPI under the Payment and Settlement Systems Act, 2007.5. Resolution and insolvency regulations. The Insolvency and Bankruptcy Code, IBC, works alongside regulators to ensure quick resolution of stressed assets and protection of creditors. 6. Developmental and promotional regulations. Regulators also play a developmental role. For instance, RBI promotes financial literacy, SEBI educates investors, and PFRDA promotes retirement planning. 7. Cross-border and IFSC-specific regulation. In international financial services centers, such as GIFT City in Gujarat, the IFSCSCA acts as a unified regulator for banking, insurance, capital markets, and funds, streamlining compliance for global players. The regulatory framework governing financial services in India. India follows a multi-regulator model where different regulators govern specific segments. 1. Reserve Bank of India (RBIO) regulates banks, NBFCs, cooperative banks, and payment systems. 0 Sets monetary policy, supervises credit flow, and ensures financial stability. 0 Oversees electronic payment platforms, UPI, IMPS, NEFT, RTGS. 2. Securities and Exchange Board of India (SEBIO) regulates capital markets, stock exchanges, brokers, mutual funds, credit rating agencies, and depositories. 0 Ensures market integrity, investor protection, and disclosure compliance. 0 Introduced reforms like T+1 settlement and stronger IPO disclosure norms. 3. Insurance Regulatory and Development Authority of India (IRDAO) supervises life, general, and health insurance companies. 0 Protects policyholders, approves products, and ensures solvency of insurers. 4. Pension Fund Regulatory and Development Authority (PFRDAO) regulates the pension sector, including the National Pension System (NPS). 0 Ensures fund safety, transparency, and efficiency for retirement savings. 5. International Financial Services Centers Authority (IFSCSCA) O, a unified regulator for all financial services in IFSCs, example, Gift City.O promotes global capital flows and cross-border financial transactions. 6. Financial Stability and Development Council, FSDCO. An apex coordination body chaired by the Finance Minister.O coordinates among regulators, monitors systemic risks, and promotes financial inclusion. Supporting legislations. RBI Act, 1934 and Banking Regulation Act, 1949 govern Banking. SEBI Act, 1992, Securities Contracts Regulation Act, 1956, and Depositories Act, 1996 govern Securities Markets. IRDA Act, 1999 governs Insurance. PFRDA Act, 2013 governs Pensions. Payment and Settlement Systems Act, 2007 governs Digital Payments. Insolvency and Bankruptcy Code, 2016 governs Insolvency Resolution. Conclusion. The regulation of financial services in India is essential to protect consumers, ensure systemic stability, and foster innovation. A multi-regulator structure, RBI, SEBI, IRDA, PFRDA, and FCSCA ensures that every sector is closely supervised, while the FSDC provides coordination. The regulatory approach combines prudential oversight, conduct rules, consumer protection, and development initiatives. In a rapidly digitizing financial ecosystem, regulations are becoming more technology-driven, balancing inclusion and safety. As India continues to integrate with global markets, its regulatory framework will remain crucial in ensuring trust, transparency, and resilience in financial services. Q2. Take any one of the credit rating agencies in India and discuss the credit rating scale used by it in detail. Answer. Credit rating agencies in India focus on CRISIL and its rating scale. Credit rating agencies, CRAs, play a vital role in the financial ecosystem by providing independent opinions on the creditworthiness of debt instruments and issuers. Their ratings act as a benchmark for investors, banks, and regulators while making lending, investment, or risk management decisions. In India, CRAs are regulated by the Securities and Exchange Board of India, SEBI, under the SEBI, Credit Rating Agencies, Regulations, 1999. Some of the leading CRAs in India are CRISIL, ICRA, CARE, India Ratings, Fitch Group, and Brickwork Ratings. For this discussion, we take CRISIL, Credit Rating Information Services of India Limited, India's first and largest rating agency, established in 1987. It is now majority owned by S&P Global. CRISIL's ratings cover corporates, financial institutions, public sector undertakings, small and medium enterprises, infrastructure projects, structured finance instruments, and sovereign local bodies. CRISIL's credit rating philosophy. CRISIL defines credit rating as an opinion on the relative credit risk associated with timely payment of interest and principal on a debt instrument. It does not assess the market price, liquidity, or suitability of the instrument for a particular investor. Ratings are based on a combination of quantitative factors, financial performance, leverage, liquidity, capital structure, and qualitative factors, management quality, industry risks, regulatory environment. Ratings are forward-looking but dynamic. They are subject to continuous surveillance and can be upgraded, downgraded, or placed on credit watch depending on new information or changes in business fundamentals. CRISIL's long-term rating scale. CRISIL's long-term ratings apply to debt instruments with maturities greater than 1 year such as debentures, bonds, term loans, and infrastructure securities. The categories are: 1. CRISIL AAO instruments with the highest degree of safety regarding timely servicing of financial obligations. O lowest credit risk. O generally issued by highly stable entities with strong financials and excellent track record. 2. CRISIL A+, instruments with high degree of safety and very low credit risk. O minor differences exist within the category based on financial strength and stability. 3. CRISIL A+, instruments with adequate safety and low credit risk. O susceptible to adverse economic conditions but still considered investment grade. 4. CRISIL BBB, BBB, instruments with moderate degree of safety and moderate credit risk. O these are the lowest investment grade instruments. 5. CRISIL BB, instruments with moderate risk of default. O classified as non-investment grade. 6. CRISIL B+, BO instruments with high risk of default. O suitable only for investors with higher risk appetite. 7. CRISIL C. O instruments with very high risk of default. 8. CRISIL Do instruments that are in default or expected to be in default soon. Modifiers within most categories, except AA and D, CRISIL uses plus and signs to provide finer distinctions of credit quality. Outlook, CRISIL also assigns an outlook, positive, stable, or negative to indicate the likely direction of the rating in the medium term, 6 months to 2 years. Credit watch when specific events such as mergers, restructuring, or regulatory changes may impact the credit profile. Instruments can be placed under rating watch with developing positive or negative implications. CRISIL's short-term rating scale. Short-term ratings apply to instruments with maturity of up to 1 year such as commercial paper, working capital facilities, and short-term debentures. Categories include 1. CRISIL A1, A1+, a 1A1, O instruments with very strong degree of safety, lowest short-term credit risk. O A1+ denotes the strongest within this category. 2. CRISIL A2O instruments with strong degree of safety and low credit risk. 3. CRISIL A3O instruments with moderate degree of safety, moderate risk. 4. CRISIL A4O instruments with minimal degree of safety, high risk of default. 5. CRISIL Do instruments already in default. Structured finance and credit enhanced ratings. CRISIL also rates structured obligations like asset-backed securities, ABS, mortgage-backed securities, MBS, and collateralized instruments. Here, ratings depend on quality of the underlying asset pool. Credit enhancements, guarantees, over-collateralization, reserve funds. Legal and structural protections. Credit-enhanced instruments, such as bonds backed by parent guarantees, may carry ratings that reflect both the standalone credit profile of the issuer and the external support. What CRISIL ratings signify? Risk benchmarking. Investors, banks, and mutual funds use CRISIL ratings to assess whether an instrument falls within their risk tolerance or regulatory investment mandates. Pricing of instruments. Higher rated securities enjoy lower yields, while weaker ratings lead to higher borrowing costs. Regulatory compliance. Many regulations mandate investment in instruments of specified minimum ratings, example, pension funds, insurers. Continuous monitoring. Ratings are not one-time. CRISIL continuously monitors issuers and can alter ratings based on performance or external environment. Limitations of ratings. While CRISIL's ratings are respected, they are opinions, not guarantees. They do not address market volatility, liquidity, or unforeseen black swan events. Investors must combine ratings with their own due diligence. The IL&FS crisis of 2018 showed that sudden corporate governance lapses can make ratings lag actual events. Conclusion. CRISIL's credit rating scale provides a transparent, structured, and systematic way of assessing credit risk in India's financial markets. By categorizing debt instruments into long-term, short-term, and structured finance scales, CRISIL equips investors, regulators, and financial institutions with a reliable benchmark for decision-making. However, ratings should be treated as one input among many in investment decisions. In the evolving Indian financial landscape, where innovation, digitization, and global linkages are deepening, CRISIL and other rating agencies remain central to building trust, reducing information asymmetry, and ensuring the efficient flow of capital. Q3. Explain the existing depository system in India. Point out the shortcomings of this system and also give your suggestions to improve it. Answer. The existing depository system in India. Structure, shortcomings, and suggestions for improvement. The Indian financial market has undergone a significant transformation since the introduction of the depository system in the mid-1990s. Before its introduction, securities trading was paper-based, leading to inefficiencies, frauds, delays, and high transaction costs. To modernize the capital markets and align them with international standards, the Depositories Act 1996 was enacted, paving the way for the establishment of depositories in India. Today, the depository system forms the backbone of India's securities market, ensuring smooth, transparent, and efficient settlement of trades. Concept of the depository system. A depository is an institution that holds securities, such as shares, bonds, debentures, government securities, and mutual fund units, in electronic form on behalf of investors. It performs a role similar to a bank, but instead of money, it holds securities. Investors open a demat account with a depository participant, DP, who acts as an intermediary between the investor and the depository. Key objectives of the system are: 1. Elimination of paper certificates and related risks, forgery, mutilation, theft. 2. Speedy settlement of trades. 3. Lower transaction costs. 4. Enhanced transparency and investor confidence. Structure of the depository system in India. India has a two-tier depository model. 1. Depositories. O. Institutions responsible for holding and maintaining securities in electronic form. There are currently 2 depositories in India: NSDL, National Securities Depository Limited, established in 1996, promoted by NSE, IDBI, and UTI.CDSL, Central Depository Services Limited, established in 1999, promoted by BSE, State Bank of India, and others. 2. Depository participants, DPs. O. Agents of depositories who provide services to investors. These include banks, financial institutions, brokers, and custodians registered with SEBI. Investors open demat accounts with DPs to access depository services. Services provided by the depository system. 1. Dematerialization and rematerialization. Conversion of physical certificates into electronic form and vice versa. 2. Account transfer and settlement. Automatic credit of securities into the investor's demat account after purchase. Debit of securities when sold, facilitating seamless settlement. T+1 cycle in India. 3. Pledging and hypothecation. Investors can pledge securities held in demat form for availing loans. 4. Corporate benefits and actions. Direct credit of dividends, interest, and redemption amounts to investors' bank accounts. Automatic update of stock splits, bonus shares, and rights issues in demat accounts. 5. Nomination and transmission. Facility for smooth transfer of securities in case of the death of the investor. 6. E-voting and governance. Shareholders can vote electronically in company meetings through their demat accounts. Advantages of the depository system. Eliminates paper risk, no risk of loss, theft, or damage to share certificates. Faster settlement. India now follows T+1 rolling settlement cycle, among the fastest in the world. Cost efficiency, lower stamp duty, reduced paperwork, and lower handling charges. Transparency, real-time updates on holdings and transactions. Investor convenience, single demat account can hold different classes of securities. Shortcomings of the existing depository system. Despite its benefits, the Indian depository system faces several challenges. 1. Concentration of market share. NSDL dominates the market in terms of value of assets held, while CDSL has more retail accounts. This uneven balance can create systemic risk. 2. Operational risks. Dependence on technology exposes the system to cyber attacks, hacking, or data breaches. Technical glitches occasionally disrupt settlement and investor services. 3. Investor awareness gaps. Many retail investors, especially in semi-urban and rural areas, are unaware of how demat and depository systems function. Cases of misuse by brokers due to investor ignorance still occur. 4. Charges and hidden costs. Although electronic trading reduced transaction costs, investors still face charges like annual maintenance charges, AMC, transaction charges, and penalties, which may discourage small investors. 5. Limited interoperability. Though SEBI has introduced interoperability in clearing corporations, complete seamless transfer between NSDL and CDSL is still evolving, creating hurdles for investors switching DPs. 6. Regulatory concerns. Instances of misuse such as unauthorized pledging of client securities by brokers, example, Carby stock broking scam, highlighted regulatory loopholes and weak enforcement. Suggestions for improvement. 1. Strengthen cybersecurity. Both depositories must invest heavily in robust IT infrastructure, encryption technologies, and AI-based fraud detection systems. 2. Investor education. Conduct nationwide awareness campaigns, especially targeting rural investors, about demat facilities, charges, and rights. 3. Transparent fee structure. Simplify and standardize DP charges. Encourage low-cost demat accounts for small investors to widen participation. 4. Enhanced oversight. SEBI should tighten monitoring of depositories and DPs to prevent misuse of client securities. Mandatory disclosure of pledge-repledge of securities should continue with strict penalties for violations. 5. Encourage competition. Promote healthy competition between NSDL and CDSL to prevent concentration risk and improve service quality. 6. Integrated services. Expand services by linking demat accounts with other investment avenues like insurance, pension funds, and government bonds, making them a one-stop investment account. 7. Retail participation incentives. Offer incentives such as reduced charges for first-time investors or students to encourage broader retail participation in capital markets. Conclusion. The Indian depository system, with NSDL and CDSL at its core, has revolutionized securities trading by replacing inefficient paper-based processes with seamless electronic settlement. It has improved transparency, reduced costs, and enhanced investor confidence. However, issues such as operational risks, uneven investor awareness, hidden costs, and regulatory loopholes persist. By strengthening cybersecurity, improving investor education, rationalizing costs, and enhancing oversight, India can further refine its depository system. As India's financial markets expand and global integration deepens, a robust and investor-friendly depository system will be essential for maintaining trust, efficiency, and resilience. Q4. Visit the website of any portfolio management services (PMS) provider and try to find out the process, working and charges of portfolio management services (PMS) offered by them. Also find out about their PMS strategies. Write a detailed report on your findings. Answer: Portfolio Management Services (PMS) by Motilal Oswal in-depth report. 1. Process and working of the PMS. *** onboarding and account setup ***. PMS is tailored for high net worth individuals, HNIs, and requires a minimum investment of 50 lakh rupees as regulated by SEBI. Investors must complete KYC, sign a PMS agreement, set up a demat account, and often provide a power of attorney (POA) for discretionary services. *** Discretionary versus non-discretionary PMS ***. Discretionary PMS, the fund manager makes investment decisions on behalf of the client based on the agreed strategy. Non-discretionary PMS, the manager advises, but the client retains final decision-making power. Motilal Oswal offers both, though discretionary is more prevalent. *** Portfolio structure and management ***. Each investor holds individual portfolios in their demat accounts, not pooled. Fund managers craft and rebalance holdings, typically 15 to 25 stocks aligned with specific strategies. Holding is transparent and flexible. *** Reporting and client interaction ***. Clients receive regular updates via email, SMS, and an online dashboard. Relationship managers assist, and higher-tier clients may speak directly with fund managers up to 7 times a month. Issue resolution typically takes up to 7 working days. 2. Charges and fee structure. Motilal Oswal PMS employs a multi-component fee model. Fixed management fee, typically around 2.5% PA as part of annual maintenance charges (AMC). Variable AMC, approximately 1.5% PA on top of the fixed component. Performance fee, about 15% of profits, applicable only if returns exceed a specified hurdle, usually 10%. Exit load, 2% within the first year, typically waived thereafter. Other costs, according to older sources: upfront fees 1-2%, brokerage 0.01, 0.05%, custodian 0.3, 0.4%, and depository charges 0.15, 0.2%. Fee variation factors. Strategy choice, investment size, and negotiation may influence fee terms. Larger investments might obtain better fee deals. 3. PMS strategies offered by Motilal Oswal. Motilal Oswal provides a diverse suite of strategies featuring different investment philosophies and market cap focuses. As of the latest data, here are key offerings. Strategy name focus area CR 1 year return %, 3 year 5 year CAGR %, fund manager of small and mid cap 694.4 23.8 25 year CAGR 4.65 Manish Sonthalia IOP V to small and mid cap to 93.14 23.6 65 year CAGR 8.71 Manish Sonthalia value migration large cap to 0.335 15 year CAGR 19.06 Shrey Lunkent top multi cap 5.93738.6 65 year CAGR 14.16 Manish Sonthalia above multi cap 1.41833.725 year CAGR 17.65 Manish Sonthalia focused mid cap 1.4056 year CAGR 23.35 Rakesh Tharve ethical strategy multi cap 5455.77 recent no. Long-term data, Rakesh Tharve multi-factor equity flexi cap, not disclosed, 73.22, recent, no long-term data, Rakesh Tharve founders, new, 2023, multi-cap, new launch, Rakesh Tharve. These strategies range from concentrated small mid-cap portfolios to diversified and thematic approaches like ethical or multi-factor investing. 4. Summary and insights. Motilal Oswal's PMS provides a structured, actively managed investment solution that combines bespoke strategy selection with rigorous research and experienced fund managers. It offers both discretionary and non-discretionary options, giving clients flexibility based on their preference for control versus delegation. Strengths. Wide array of strategies, transparent reporting, and strong client servicing infrastructure, track record of outperforming benchmarks. Example, several strategies delivered 30-70% in 1 year returns. Considerations. High minimum investment, 50 lakh rupees, tiered fees, fixed plus variable plus performance, can significantly eat into net returns. Exit load within 1 year adds commitment. Final takeaway. If you are an HNI seeking personalized portfolio management with clarity, accountability, and alignment to your investment goals, Motilal Oswal PMS offers a compelling option, provided you are comfortable with the fee structure and minimum commitment. Q5. Explain the chronological progress of technology in banking. Discuss the revolution brought about by technology in the payment and settlement systems. Answer. Chronological progress of technology in banking and revolution in payment and settlement systems. 1. Introduction. Banking has always been central to economic growth, but the way it functions has evolved drastically over time. Earlier, banking operations in India were manual, paper-driven, and time-consuming, with customers required to physically visit branches for all services. The introduction of technology has brought a paradigm shift, making banking faster, more efficient, secure, and customer-centric. The progress can be traced chronologically through distinct phases, each contributing to modern payment and settlement systems that drive today's cashless economy. 2. Chronological progress of technology in banking. I. Pre-computerization era before 1980s. Banking operations were completely manual. Passbooks, ledgers, checks, and demand drafts dominated the system. Transactions took several days to clear because of inter-branch communication delays. Errors, fraud, and inefficiency were common due to reliance on human handling. 2. Introduction of computerization, 1980s. The Reserve Bank of India (RBI) and committees such as the Rangarajan Committee recommended computerization to improve accuracy and speed. Standalone computers were first introduced to process deposits, withdrawals, and interest calculations. This was the foundation of core banking solutions, CBAs, though initially limited to individual branches. 3. Networking and core banking, 1990s, 2000s. Banks moved from isolated computer systems to networked systems, enabling branch connectivity. Core banking solutions, CBAs, allowed customers to operate accounts from any branch of a bank, anywhere. Banking. Automated teller machines, ATMs, were introduced, allowing 24/7 cash withdrawal and balance inquiry. Electronic payment systems like electronic funds transfer, EFT, and electronic clearing services, ECS, emerged in this period. 4. Digital banking era, 2000s, 2010s. The rise of the internet and mobile phones triggered internet banking and mobile banking. Banks introduced services like NEFT, National Electronic Funds Transfer, in 2005 and RTGS, real-time gross settlement, in 2004 for large value transfers. Debit and credit cards gained popularity, supported by point-of-sale (POS) terminals. This era marked the beginning of paperless banking, with customers able to transact without visiting branches. Fintech and Payment Revolution, 2010s present. The launch of the Unified Payments Interface, UPI, in 2016 revolutionized real-time, low-value digital payments in India. Digital wallets like Paytm, PhonePe, and Google Pay became common, integrating with banks and offering instant transactions. The Immediate Payment Service, IMS, allowed 24/7 interbank transfers. Aadhaar-enabled payment systems, APS, and biometric authentication further boosted financial inclusion. Banks now use artificial intelligence, AI, robotic process automation, RPA, and blockchain to enhance services and security. 3. Revolution in payment and settlement systems. The technological journey culminated in a complete transformation of payment and settlement mechanisms in India, overseen largely by RBI and NPCI, National Payments Corporation of India. Earlier challenges. Clearing checks across cities could take 7 to 10 days. High dependency on cash led to risks of theft, counterfeiting, and inefficiency. Manual reconciliation of interbank settlements delayed economic transactions. 2. Check truncation and MICR. Introduction of magnetic in character recognition, MICR, reduced check clearing time. Later, check truncation system, CTS, eliminated the need for physical check movement by using scanned images, reducing clearing time to 1 to 2 days. 3. Electronic payment systems. RTGS, 2004 enabled real-time settlement of high-value interbank transfers, enhancing liquidity. NEFT, 2005 facilitated batch-wise transfer of funds electronically, initially operational in working hours, now available 24/7. IMS, 2010 introduced instant fund transfers 24/7, boosting retail digital payments. 4. UPI revolution, 2016 onwards. The Unified Payments Interface, UPI, created a real-time, interoperable, and mobile-first platform. UPI links multiple bank accounts into one app, enabling payments via virtual addresses, QR codes, or mobile numbers. Today, UPI handles billions of transactions monthly, making India a global leader in digital payments. Other innovations. Aadhaar-enabled payment system, APS provides banking services in rural areas via biometric authentication. FASTag and NCMC, technology-driven solutions for toll payments and transport ticketing. BPPS, Bharat Bill Payment System Unified Platform for Utility Bill Payments. Blockchain experiments, RBI and select banks are testing blockchain for faster, more transparent settlements. 4 benefits of technological progress. Speed and efficiency, transactions that once took days now occur instantly. Financial inclusion, mobile banking, UPI, and APS have reached rural populations. Cost reduction, paperless and automated systems cut operational costs for banks. Security, encrypted payments, biometric IDs, and AI-based fraud detection enhance safety. Customer convenience, 24/7, anytime anywhere banking has become a reality. 5 remaining challenges. Cybersecurity risks, increased digital transactions invite hacking and phishing threats. Digital divide, rural and elderly populations may struggle with digital adoption. System downtime, occasional failures in UPI or NEFT impact trust in digital systems. 6 suggestions for improvement. 1. Stronger cybersecurity frameworks and user awareness campaigns. 2. Enhanced digital literacy programs in rural and semi-urban India. 3. Investment in blockchain-based settlement systems to reduce fraud. 4. Building resilient IT infrastructure to minimize downtime. 5. Encouraging interoperability and innovation in fintech collaboration. 7. Conclusion. The progress of technology in banking has been nothing short of revolutionary. From manual ledgers to instant mobile transfers, Indian banking has undergone a digital transformation that has redefined customer experience and strengthened the economy. The revolution in payment and settlement systems, especially with UPI, IMPS, and NEFT, has positioned India as a global leader in digital finance. While challenges remain, continued innovation and regulatory oversight will ensure that the Indian banking system remains future-ready and globally competitive.